Hi everyone. So now let us continue with the financial instruments. So these financial instruments is covered under IAS 32 as well as IFRS 9 that has been updated to replace the old standard called IAS 39. So first let us start with the definition of financial instrument. So what is financial instrument? So financial instrument is a contract that gives rise to a financial assets of one entity and a financial liability or equity instrument of another entity. So to help you understand, the simple example that I can give you is like receivables. So receivables is one example of financial instrument whereby we expect to receive payment from our debtors. So receivables is therefore one form of financial assets. So when we talk about financial instruments, basically there are three different categories. So the first category is financial assets. So the best example would be receivables, like what I explained just now. Other than that, it can also be in form of equity investment or debt investment. So this is basically like our long-term investment. So sometimes we purchase shares from another company, or we can also be purchasing debentures or bond loan stocks from another company. So this is what we call as financial assets. So basically, the best example of financial asset is like investment that we make by buying ordinary shares, or it can also be in the form of a bond whereby we buy debentures or loan stocks from another company. The second category of financial instrument is what we call the financial liability. So financial liability relates to contractual obligations. So this is when, let's say, the company need money. So one way to raise fund is actually by issuing bonds or debentures. So this is one form of financial liability. And the last type of financial instrument is what we call the convertibles. So convertibles is quite unique, whereby it has the characteristic of both the equity as well as the liability. So for convertible part, I will explain about it more later when we look into the convertible example. Alright, so financial assets, like I give example just now, is basically about investment. For example, when we buy shares from another company, or when we buy debentures, loan stocks from another company, this is what we call as the financial assets. So how do we record the purchase of this kind of financial assets? So how do we record investment? So basically, we have to record at fair value by including the transaction cost, meaning that we are allowed to capitalize the transaction cost if we buy the investment for the purpose of long-term investment. However, if we buy the investment for the purpose of trading, then it should be calculated as fair value through profit or loss. So we will look into the difference. What is the difference between these two later on? So basically, when we want to value our financial assets, there are two methods. One method called financial value, fair value through OCI, or fair value through profit and loss. So basically, there are two ways of measuring the financial instruments. So under this method, we are allowed to capitalize the transaction cost, but in this method, transaction cost has to be expensed off immediately into the income statement. So basically, there are two ways. So we will use OCI, FVT OCI, when the investment is held not for trading purpose, but when we buy an investment for trading purpose, meaning that we want to benefit from the gain or loss of investment, then you have to expend off the transaction cost. Alright, so when we talk about financial assets, like I explained just now, there are two types. One example would be equity instrument, and the other example would be debt instrument. So equity instrument would be categorized as part of our financial asset if we bought the interest in that another company of less than 20%. So these represent equity instrument. So all equity investment in this scope are to be measured at fair value in the statement of financial position with value changes recognized in the profit or loss. Okay, so meaning that if we buy an equity investment for trading purpose, then you have to recognize the changes in the P&L. But however, if we buy a particular equity investment and we have elected to record the present value changes in the OCI, so meaning that we are not buying the investment for trading purpose, so this method is what we call fair value through OCI. So we will look into one example later on. How do we value based on these two methods? So don't worry. Alright, so debt instrument could be also one example of financial asset, like I explained just now. Sometimes we buy, we are not just buying shares, sometimes we can also buy debt. So if let's say you buy a bond or debentures from another company, so in order to record this debt instrument, normally we will use the amortization method. We can use this amortized cost as long as it fulfills these two different criteria. Firstly is we buy the debentures or the loan stock in order to hold the financial asset to collect the contractual cash flows, meaning that we have the intention to wait until the maturity of the loan stock. For example, if we buy bonds or we buy debentures, normally it is for a period of 5 years to 10 years. So when you buy this kind of bonds, okay, you are willing to wait until the maturity date. Okay, so if this test is what we call business model test. And another criteria is cash flow characteristic test, whereby at the end of the period, we want to earn the principal as well as the interest outstanding. Okay, so why do we wait until the maturity date? Because we want to get back the money that we have invested earlier. So this is the debt instrument for the financial assets. Okay, let's look into the example. Alright, we have one example here. Vilma purchases 10,000 shares in Fred, representing a 7% shareholding on 1st June 2005 at a cost of 3.5 pound. Okay, so this is how much that Vilma purchased. Oops. Let me erase that. Sorry. Okay, so Vilma purchased 10,000 shares in Fred, and then at the cost of £3.50. Transaction cost is £900. So as at the end of financial year 30th June 2005, share market value increased to £4 each. So there are two requirements here. First, show how to account for investment in share of Fred for the year ended 30th June 2005. So another hint here that we have to highlight is this one. Vilma buy the shares from Fred for trading purpose, meaning that you are buying this investment. You do not have the intention to keep this investment for long. You just buy it for trading purpose, meaning that one day within the near future, in less than 12 months, you could be selling these shares because you want to benefit from the gain of the investment. So this indicate that we need to use fair value through profit and loss. So requirement number 1 is actually asking us to record this transaction based on this method. Okay, requirement number 2, show how the accounting treatment would differ if Vilma intended to hold these shares for the long term, meaning that this investment is held for investment purpose, not for trading purpose. So in this case, we have to use the other approach to record, which is by using fair value through OCI. So we will look into the difference here. What is the difference between fair value through profit and loss and fair value through OCI? So let's look at the first requirement first, how to record based on FVTPL. Alright, so let's say if we want to record based on FVTPL approach, okay, so first you have to calculate the cost of investment. So for this one, Vilma wants to purchase 10,000 shares and the cost is £3.50. So the total cost of investment is £35,000 and Vilma has to incur a transaction cost of £900. So since we are using this method, fair value through profit and loss, you must remember that the transaction cost need to be expensed off immediately. So this one, this 900 is considered as your expenditure. This is your expense. Alright. So for the year ended 30th June 2005, how do you do the recording? Of course, you have to debit investment because increase in asset, debit transaction cost. So this one, you have to record in your P&L, okay, as expenses, and you have to credit your bank or cash because we buy this investment, so we assume that we are using bank or cash in hand, okay. And apart from that, at the end of the year, there is an investment revaluation. So if you still remember the question, at the end of the year, the share price increased to £4. So meaning that our total investment has increased from 35,000 initially when we bought the investment, it was £35,000. Now as at the end of the year, it increased to become 40,000. So this is a worthwhile investment. So meaning that you gain by buying this investment. So how do we record this? Again, you have to record this 5,000 as an increase in investment. So you debit investment 5,000 and you credit gain on revaluation 5,000. This one will be in your P&L. Okay, so this is how we record the transaction by using FVTPL method. So this is how we answer requirement number 1. Let's look at requirement number 2. Alright, so let's say Vilma purchased this investment for long-term investment. Okay, not for trading purpose. So in this case, we have to record based on FVOCI. So the only difference between FVTPL and FVTOCI is how do we treat the transaction cost. Okay, this is the first difference, the transaction cost. And also when we are recognizing the increase in the value of the investment. Alright, so let's look at this transaction cost first. So if we are buying an investment for long-term purpose, we are allowed to capitalize the transaction cost. So meaning that these transaction costs will be part of our asset. So meaning that as at the end of the year, when you want to record the purchase of investment, it is no longer 35,000, but you have to include this transaction cost because this is now part of your assets, not your expense anymore. and again credit your bank or cash. So at the end of the year, share price increased to £4. So you have to recognize the increase in the value of the investment. So now our investment value is 40,000, and then you have to minus with this one 35.9. Okay, so meaning that there is a difference of £4,100, and this has to be recognized as part of your other comprehensive income. Okay, so this is how we record the purchase of financial assets. So please look into the next video whereby we will discuss on the convertibles.